Your financial goals are very close, maybe this year, but you have a lot of money invested in the equity markets. And it seems like the equity markets are going to do very well in the next 1 or 2 years. What do you do? There's always a temptation. Let the money be invested into equities, either in stocks or mutual funds. But is that the best strategy to follow? We'll see that in today's video, and I'll take you through a very simplistic example to show you what can happen if you continue your investments in equities and what are the different scenarios that may happen. I'm Frankie Fernandez. I'm a certified financial planner and I'm also a marriage coach. My goal is to help families to grow their wealth and their marriage. And today, what I'm going to talk to you is to actually protect your wealth. That is the goal of today's session. So, what do you do when you are close to your financial goals and most of your investments are into equities? You must consider rebalancing your portfolio and relook at your asset allocation. Now, what is rebalancing of portfolio? Basically, a portfolio consists of different asset classes. You've got equities, you've got debt. Equities could include stock, mutual funds. Debt could include fixed deposits or mutual funds, liquid funds, ultra short, or even hybrid funds. And then you could have gold, you could have land, and these are the different asset classes. Asset allocation is having a certain percentage into each asset class so as to meet your financial goals based on your time horizon and also your risk profile. Now, what we are assuming here is that your asset is mostly of equities and you have financial goals this year or probably next year. What do you do? What is the strategy that you need to use? Most of us miss out on this because we are so absorbed and so much of positivity, so much of optimism in the market that we do not think about what if anything goes wrong, what can happen. Just imagine your portfolio is total 40 lakhs, and out of which 35 lakhs is equities, stocks, mutual funds, and the remaining 5 lakh is into debt. It's into a FD or a liquid fund. As I mentioned, this is a very simplistic example. You can use your own portfolio, which could be far more diverse, right? My focus is more onto equities, and that's what I want to share with you. Now, you have a financial goal in 24 or 25, which is this year or the next year, and you have your children's higher studies. You have earmarked 15 lakhs. Obviously, you have saved over these years, and the goal is 15 lakhs, which is this year or next year. And you have arrived at the 40 lakh, which we talked about, by investing 40,000 per month in the last 5 years, and you have received a returns of around 15%. Based on this, you have right now 35 lakhs. And that 35 lakh is broken up into retirement 20 lakhs, children's studies 15 lakh. That makes up 35 lakh. So this is what it comprises of. And we are talking about the children's studies 15 lakh. Now, this is something that you have to consider. Let's remember this fact that equity markets, they do not linearly go up by 12% or 15%. Sometimes they go up by 30%, 50%. Sometimes they drop by 30%, 15%. Sometimes they are flat. So equity markets can either go up, remain flat, or go down, right? So the money that you have right now invested into equities can either go up, go down, or remain the same. Now I'm going to show you the BSE Sensex from April 21 to 24. What has happened? This is the yellow line is the market. Now it has from 21 to 24, obviously it has gone up, right? From close to 50,000, now it is above 70,000. But in this period, it has not linearly gone up. If you see, there are periods when Can you see the blue line? There are periods when the market has remained flat for more than a year. There are times when the market has gone down and the markets have gone up. Yes, most of the times the market has gone up, sometimes flat, and sometimes it has fallen. If you look at from April 21 to 24 on a rolling 12-month period, the market has, for 7 times, the market has given 15 to 20% returns. And for 5 times, it has given 10 to 15% returns, which means more number of times it has given positive returns, about 10%, which is good. But 6 times it is given less than 10%, that is between 5 and 10%. And 7 times it is given between 0 and 5%, which means, and 5 times it is flat. That means 5 times it has remained the same, flat. It has not given any returns, which means if you had invested in these 5 times, your money would not have grown. Of course, that is not practical. We invest throughout the year, especially if you're doing an SIP. One time it has given negative returns. Now, what does this tell us? It tells us that the probability of markets going up, down, and flat are almost the same, like 33%, one third of the time. So you cannot say for sure that the next few years the market will only go up. We don't know. Especially this year, it's a year of elections, and the markets probably have already factored that in. Hence, the market has been going up, assuming that the ruling party will win. And we do not know this. The ruling party may win with a huge win, an ordinary win, we do not know. Markets have already been factored in, so it may go up slightly. But markets also can go down and the markets can remain flat. In the last a year or so, the markets have gone up phenomenally. In the last 3 years, the market have gone up by 50%. So markets can't keep going up. It may remain flat, it may go down. We don't know. Now let's take an assumption. If the market goes up by 10% or goes down by 10% or remains flat. Now your 35 lakh portfolio, right? If it goes up, it becomes 38.5 lakh and you get a profit of 3.5 lakh. If the market remains flat, there's no change. You don't gain anything in the next 1 year. If the market falls, you lose 3.5 lakh, right? So this can happen because the probability is 1/3. So what do you do with your investments, where you have a financial goal of 15 lakhs for children's education? What do you do? This is the time to rebalance your portfolio, relook at your asset allocation, because you have a financial goal this year. Children's education, right? Your child's education, and you need 15 lakhs, which you have. So what you need to do is sell your equity investments and move them to less volatile. I'm not saying move them to less risky. At this point, it is more of volatility. Equities are good and our country's economy is good, but they are volatile. So you move them from a volatile bucket into a less volatile bucket. And what are the less volatile bucket? They are the debt funds or the hybrid funds. Debt funds are pure debt. They invest in debt instrument, corporate bonds, government bonds. So you get roughly 5, 6, 7% returns. And hybrid funds, which have a combination of equity and debt, I would recommend invest in a hybrid conservative where 70 to 80% of your money will be into debt, into corporate bonds, and the remaining will be into equities. So even if the equity market goes down, you don't lose because you already have a huge portfolio with debt. Now take a look at this children education financial goal impact of your decision. Look at the chart here. You have equity, 15 lakhs. If you continue to keep invested 15 lakhs, if the market goes up, obviously you gain 1.5 lakh. But if the market goes down, you lose 1.5 lakh. I just want you to pay attention here. You gain 1 lakh 50, But if the market falls, you lose your current principal, which is 15 lakh. You lose principal of 1.5 lakh. Now, what if you were to invest into a hybrid fund, hybrid conservative? 15 lakhs, if the market goes up, it becomes 16 lakh 2000. Not bad. You still gain. You still gain 1 lakh 2000, which is you have lost 48,000 gains compared to equities. But what if the market goes down? You still gain. You still gain 42,000. Why? Because hybrid funds have a small component of equity and more component of debt, because of which you stand to gain. And see the difference. When the markets go down, you still get 42,000 capital gains. And if the market goes up, you get 1 lakh 2000 gain. And see here what you lose. You lose 48,000 gains if you invest in hybrid funds. But if the markets are down, compared to the equity portfolio, you stand to gain by 1 lakh 92,000. So if you see, it's overall win-win when you move your funds from equities into less volatile asset classes. I know the temptation is to wait. What if the market goes up? But as I mentioned, the probability of the market going up is just 1/3, because the markets can remain flat, the markets can go down. And in the last more than a year, we have witnessed a lot of gains. And an equity market cannot keep going up. It'll correct at some point, and then again it'll go up. What we are looking at is not the long term. We are not looking at 5, 10 years. If it was 5, 10 years later, I would say let the money be there. In fact, invest more when the market goes down. But what we are talking about is a short term. Basically, in the next 6 months to 1 year, if you have financial goals, you cannot take that risk of keeping your funds into equities because the markets are volatile. By moving your funds from equity to less volatile asset classes, you tend to protect your funds. This is basically protecting. When you're rebalancing your portfolio, it is to protect your funds. When you're relooking at your asset allocation, it is you to protect your funds, because this year or next year you have a financial goal and you don't want less funds. You don't want to lose your money. So this is something that you need to remember as you consider your financial goals. And this is not just for this year or next year. Maybe you have a financial goal in the next 5 years. You can use the same concept 1 or 2 years before. Ensure that you move it into a less volatile asset class. It is said that during 2008 crisis, the markets fell and many people in the US postponed their retirement because their money had crashed, because most of their money was into equities. They did not follow this strategy. They kept on thinking the markets will keep going up. You can postpone retirement. You cannot postpone your child's education. I hope you got some insights. If you have any questions, please post your comments. If you think you have something better, please post your comments. And if you have liked this video, please give a like and do subscribe. See you soon.